Okay, so you want to own Tesla, not just drive one. Own the whole thing. The gigafactories, the charging network, the software, the robots, the brand that made electric vehicles cool before electric vehicles were cool. You picture Elon Musk on stage unveiling the next product, the stock ticker climbing, the future arriving ahead of schedule. You are not buying a car company. You are buying a bet on the future of energy, transportation, and artificial intelligence all at once. That is the pitch. That is what gets people excited at dinner parties and keeps retail investors glued to their brokerage apps at midnight. Here is what that pitch leaves out. Tesla has spent most of its existence on the edge of bankruptcy. It has missed production targets so many times that Wall Street analysts built entire careers around predicting which miss would finally sink it. Its CEO has burned investor trust, regulatory goodwill, and billions of dollars of capital on projects that had nothing to do with selling cars. And in 2024, for the first time in over a decade, Tesla reported a year-over-year decline in vehicle deliveries. Not a slowdown, an actual decline. In the middle of the decade that was supposed to be the electric vehicle decade. So the question is not whether Tesla is an interesting company. It obviously is. The question is what you are actually buying when you buy Tesla. What it costs to build and run a business like this. What the real math looks like underneath the headlines. And why some of the smartest investors in the world cannot agree on whether this company is worth $500 billion or $5 trillion. Let us figure that out. Before we talk about money, we need to talk about what Tesla actually sells. Because the answer is more complicated than cars, and getting it wrong is the single most common mistake people make when trying to value this company. On the surface, Tesla is an automobile manufacturer. It designs, builds, and sells electric vehicles. The Model 3, the Model Y, the Model S, the Model X, the Cybertruck. You can walk into a Tesla store, configure a car on a touchscreen, and drive it home. By that definition, Tesla is a car company competing with Ford, General Motors, Toyota, and Volkswagen. But car companies do not trade at the valuations Tesla commands. In 2024, Tesla's market capitalization at various points exceeded the combined value of Toyota, Volkswagen, Ford, and General Motors put together. Four of the largest automobile manufacturers in history, companies that collectively sell tens of millions of vehicles per year, worth less than a single company, selling roughly 2 million. That math only makes sense if Tesla is not actually being valued as a car company. And it is not. What Tesla is actually selling to the investors who set its price is a story about four separate businesses that happen to share a balance sheet. The first is the vehicle business, the one everyone can see. The second is the energy business, solar panels and utility-scale batteries that store power for homes and grids. The third is the software and services business, autopilot subscriptions, over-the-air updates, and the full self-driving package that Tesla has been selling as imminent for the better part of a decade. And the fourth is the robotics and artificial intelligence business, the Optimus humanoid robot, and the Dojo supercomputer, which Tesla claims will eventually be worth more than everything else combined. The reason this matters is that each of these businesses has completely different economics, completely different timelines, and completely different risk profiles. When you buy a share of Tesla, you are not buying a car. You are buying a weighted bet across all four, and the weighting is entirely a matter of what you believe about the future. Two intelligent people looking at the same balance sheet can reach valuations that differ by a factor of 10. And both can make a coherent argument. That is not normal for a company of this size. And it is the source of almost everything interesting and terrifying about Tesla's economics. Nobody builds a car company from scratch. The conventional wisdom in the automotive industry, repeated so often it became dogma, was that the barriers to entry were simply too high. You need factories, you need supply chains, you need dealers, you need regulators, you need crash test programs and emission certifications and service networks. The capital required to compete with established players was so enormous that no serious investor would fund a startup into the space. Tesla proved the dogma wrong, but not cheaply. The company was founded in 2003 and spent its first 7 years burning through cash at a rate that would have destroyed most businesses. By 2008, during the financial crisis, Tesla was within days of bankruptcy. Elon Musk, who had joined as chairman and later became CEO, invested his last personal funds from the sale of PayPal into keeping the company alive. The amount he put in during that period, combined with a last-minute investment round and a Department of Energy loan of $465 million, is what kept Tesla from disappearing before most people had ever heard of it. Building a single gigafactory, the name Tesla gives its large-scale manufacturing facilities, costs between $5 and $10 billion. The original Gigafactory in Nevada, built in partnership with Panasonic to produce battery cells, cost approximately $5 billion for the first phase alone. Gigafactory Shanghai, which opened in 2019 and became Tesla's most efficient production facility, required approximately $2 billion in initial investment plus ongoing expansion capital. Gigafactory Berlin and Gigafactory Texas each required similar capital commitments and both experienced significant production ramp challenges that cost hundreds of millions in lost revenue during their first years of operation. Then there is the Supercharger network. Tesla did not just build cars. It built the infrastructure required to make those cars usable, a network of proprietary fast charging stations across North America, Europe, and parts of Asia. By 2024, Tesla operated more than 60,000 supercharger stalls globally. Each supercharger station costs between $300,000 and $600,000 to install, depending on location and the number of stalls. The network as a whole represents a capital investment that runs into the billions, built over more than a decade, and it is both a competitive advantage and an ongoing maintenance obligation that never stops drawing capital. The total capital Tesla has raised and spent since its founding, across equity raises, debt issuances, government loans, and reinvested earnings, runs well into the tens of billions. This is not a business you build with a great idea and a small team. It is one of the most capital-intensive enterprises in the modern economy, and the entry cost alone should recalibrate any casual assumption about how easy it was or how easily it could be replicated. Here is where the story gets genuinely interesting. Because the way Tesla generates revenue today is not the way most people assume, and it is certainly not the way Tesla hopes to generate revenue in the future. In 2023, Tesla reported total revenues of $97 billion. Of that, approximately $82 billion came from automotive sales, meaning the actual selling of vehicles. The remaining $15 billion came from energy generation and storage, services, and other sources. On the surface, that looks like a straightforward car company revenue structure, but the margin profile underneath that revenue tells a completely different story. Tesla's automotive gross margin, the percentage of every car sale dollar that remains after paying the direct cost of building the car, has been one of the most watched numbers in the investment world for years. At its peak in 2022, Tesla's automotive gross margin reached an extraordinary 29%. For context, Toyota, the most efficiently run traditional automaker in the world, operates at automotive gross margins of around 15 to 18%. Tesla was producing a margin nearly double the industry benchmark, and it was doing it while growing volume faster than almost any automaker in history. That margin became the central argument for Tesla's premium valuation. If Tesla could sustain a 29% automotive gross margin at scale, the profit potential as volume grew was essentially unprecedented in the industry. The bulls were not wrong about the logic. The problem was what happened next. In 2023 and 2024, Tesla cut prices, repeatedly, aggressively. In some markets, Model 3 and Model Y prices fell 20 to 30% from their 2022 peaks. The cuts were driven by weakening demand, rising competition from Chinese electric vehicle manufacturers, and Elon Musk's stated strategy of sacrificing margin to maintain volume. The result was that automotive gross margin fell from 29% to approximately 17% by the end of 2024, still competitive with the best traditional automakers. But the premium that justified a premium valuation had compressed dramatically, and it did so in less than 2 years. This is the central tension of Tesla's current economics. The vehicle business, which generates the overwhelming majority of revenue today, has become more competitive and less differentiated than it was. The businesses that would justify valuation multiples above a traditional automaker, software, energy, and robotics, are either still small, still unprofitable, or still theoretical. The energy business is the most underappreciated part of Tesla's current operations. Tesla's Powerwall home battery, PowerPack commercial battery, and Megapack utility-scale battery products constitute a genuine and growing business that most Tesla coverage ignores entirely. In 2024, Tesla's energy generation and storage segment deployed a record amount of battery capacity and generated revenues growing significantly faster than the vehicle business. The Megapack, a large-format battery designed for utility companies and grid operators, has a multi-year order backlog. As electricity grids worldwide integrate more renewable energy and require storage to manage intermittency, the market for grid-scale batteries is expected to grow substantially through the next decade. Tesla has a meaningful head start in this space, and the margin profile of the energy business has been improving. This is the quiet part of Tesla that the stock price arguably does not yet fully reflect. No part of Tesla's business has generated more controversy, more regulatory scrutiny, and more investor debate than full self-driving. This is the software package that Tesla has sold to customers for prices ranging from $8,000 to $15,000, depending on when they purchased it, with the explicit promise that it would eventually enable a Tesla to drive itself without human supervision. The operative word is eventually. Tesla has been selling full self-driving in some form since 2016. As of 2025, it still legally requires a human driver to remain attentive and ready to intervene at all times. It is, by regulatory definition, a driver assistance system rather than autonomous driving. The gap between what the name implies and what the product currently delivers has been the subject of multiple federal investigations, National Highway Traffic Safety Administration inquiries, and a significant ongoing scrutiny from the Securities and Exchange Commission. Here is why this matters economically beyond the legal exposure. If full self-driving ever works as described, the revenue model changes fundamentally. Tesla has suggested that a fully autonomous vehicle could be deployed as a robotaxi, earning revenue 24 hours a day without a driver, and that the software enabling this capability would be licensed at a price point that generates recurring revenue on every vehicle Tesla has ever sold. Elon Musk has at various times suggested that the autonomy business alone could be worth more than Apple. The logic, if the technology works, is not incoherent. A fleet of millions of autonomous vehicles generating ride-hailing revenue around the clock is a fundamentally different asset than a car sitting in someone's driveway depreciating. But if it does not work, or does not work on the timeline the valuation assumes, then Tesla has been collecting payments for a product it has not delivered, facing legal and regulatory consequences that could be severe, and investors have been pricing in a revenue stream that does not exist. That is not a minor risk. That is an existential question for the portion of Tesla's market cap attributed to autonomy. In 2024, Tesla launched its Cybercab robotaxi concept and announced plans for a limited robotaxi service in specific markets. The reception was cautious. The technology demonstration did not resolve the fundamental questions about whether the system could handle the edge cases, the unexpected pedestrian, the construction zone, the unmarked rural road that define the difference between a useful autonomous vehicle and a dangerous one. There is a variable in Tesla's economics that does not appear on any balance sheet and cannot be modeled in any spreadsheet. That variable is Elon Musk. No other company of Tesla's scale is so completely identified with a single individual. Apple survived the death of Steve Jobs. Microsoft thrived for decades under leaders who were not Bill Gates. Tesla's market value has moved by tens of billions of dollars in single days based on tweets, interviews, and public statements made by its CEO on platforms he personally owns. This is not a normal relationship between a company and its leadership. The concentration risk is real, and it has already produced measurable damage. During 2022 and 2023, Musk's purchase of Twitter, later rebranded as X, consumed enormous amounts of his time and attention during a critical period when Tesla was navigating production challenges at new factories, facing rising competition, and making pricing decisions with long-term margin implications. Tesla's board, which has faced persistent criticism for lacking independence from Musk, approved a compensation package that was later voided by a Delaware court as an improper transfer of shareholder wealth, a legal saga that distracted management, generated significant legal costs, and raised fundamental questions about corporate governance at one of the world's most valuable companies. There is also the brand dimension. Tesla built its identity around a combination of technological aspiration and a certain kind of cultural cool. Musk was central to that identity, but a CEO's personal brand is not a permanent asset. It can appreciate, and it can depreciate. And the events of 2023 and 2024 raised genuine questions in certain consumer demographics about whether Musk's political profile had begun to affect Tesla's brand appeal in ways that were influencing purchase decisions. Tracking this precisely is difficult. But the combination of declining delivery growth in markets with significant sensitivity to brand values was not a coincidence most analysts were willing to dismiss entirely. The honest assessment is this. If Musk executes on autonomy and robotics, he will be remembered as the person who built the most valuable company in history. If the technology does not arrive, or arrives too slowly, or if his attention continues to be divided across multiple major enterprises simultaneously, Tesla's valuation will eventually need to be reconciled with the economics of a well-run but increasingly competitive electric vehicle manufacturer. Those are two very different outcomes, and the distance between them is measured in trillions of dollars. When Tesla launched the Model S in 2012, it was competing against nothing. There were no serious luxury electric vehicles from established manufacturers. The product was so far ahead of the market that early customers were essentially paying a premium to be pioneers. That competitive vacuum is what allowed Tesla to build its brand, its margins, and its loyal customer base without having to fight for market share. That world no longer exists. In China, which is the largest electric vehicle market on Earth and a market Tesla depends on for a significant portion of its global volume, BYD surpassed Tesla in total electric vehicle deliveries in 2023 and has continued to extend that lead. BYD is not a startup. It is a company backed by Warren Buffett's Berkshire Hathaway, vertically integrated from battery cell production through finished vehicles, with a cost structure that allows it to price electric vehicles at levels Tesla cannot match without destroying its own margins. The cheapest BYD electric vehicle in China sells for the equivalent of $10,000. Tesla's cheapest offering is roughly 3 times that price. In Europe and North America, Volkswagen, Hyundai, Kia, BMW, and Mercedes have all launched competitive electric vehicles with established dealer networks, brand recognition, and the manufacturing scale to sustain price competition over years. These are not theoretical competitors. They are companies that sold a combined total of tens of millions of vehicles last year, have invested hundreds of billions in electric vehicle transitions, and have cost structures built on decades of manufacturing efficiency that Tesla is still working to match. The competitive environment that Tesla faces in 2025 looks nothing like the one that existed in 2018 or even 2021. And the margin compression of the past 2 years is at least partly a direct consequence of that change. When you are the only serious option, you can charge whatever you want. When you are one of a dozen serious options, the market sets the price. Let us run the numbers honestly. In 2023, Tesla delivered approximately 1.8 million vehicles. Revenue was $97 billion. Net income was $15 billion. That is a net profit margin of approximately 15%, which is exceptional by automotive industry standards. For context, Toyota's net margin runs around 7 to 9%. Tesla was generating roughly double the profitability per dollar of revenue of the most efficient traditional automaker on Earth. But here is the number that tells the real story of where Tesla is in 2024 and 2025. In the first half of 2024, deliveries declined year over year for the first time in Tesla's public history. Net income margins compressed from 15% to single digits in certain quarters as price cuts flowed through the income statement. The automotive gross margin, which had peaked at 29%, settled into the high teens. The stock, which had recovered from its 2022 lows, remained extraordinarily volatile as investors tried to reconcile short-term operational pressure with long-term technology optionality. The core problem the numbers reveal is this. At a market capitalization that at various points in 2024 and 2025 ranged between $600 billion and $1 trillion, Tesla was trading at a price-to-earnings ratio of somewhere between 50 and 100 times earnings, depending on the period. Toyota, producing approximately 10 million vehicles per year and generating reliable profits across decades, trades at a price-to-earnings ratio of around 10. The only way to justify the gap is to believe that Tesla's future earnings from autonomy, energy, and robotics will be so much larger than its current earnings that the comparison to a traditional automaker is simply the wrong framework. That belief may be correct, but it requires a lot of things to go right on a timeline that has already slipped multiple times in markets that are more competitive than they have ever been. The math works if the technology arrives. It does not work if Tesla is, 5 years from now, a well-run electric vehicle company with a 15% net margin and 2 million vehicles per year of volume. At those numbers, the valuation implies a price that would represent one of the most significant overvaluations in modern financial history. Here is what the good version of the next decade looks like. Full self-driving achieves regulatory approval for unsupervised operation in major markets. Tesla launches a robotaxi network that generates recurring software revenue at margins far above anything possible in vehicle manufacturing. The Optimus robot enters commercial production and finds real industrial applications that justify scale. The energy storage business doubles in size as grid operators worldwide install megapacks, and the combination of these businesses transforms Tesla from a premium car company into a diversified technology platform generating revenues and margins that make the current valuation look, in retrospect, modest in that world. The people who held Tesla through the difficult years of 2023 and 2024 look like the people who held Amazon through the years when everyone said the valuation was impossible to justify. Here is what the realistic version looks like. Full self-driving continues to improve incrementally, but does not achieve the step change in capability required for unsupervised regulatory approval in the near term. Chinese competition continues to pressure Tesla's volume and margins in the world's largest electric vehicle market. European and American competitors close the technology gap faster than expected as they integrate their own AI and software capabilities into vehicles. The energy business grows steadily, but not at a scale that moves the needle on total company valuation. And Tesla settles into its role as a very profitable, very well-managed premium electric vehicle manufacturer with a loyal customer base, a strong brand, and a market capitalization that, while still significant, no longer reflects the multiple of a technology company. In that world, the long-term return on Tesla equity from current prices is decent but not exceptional, and the investors who paid for the technology optionality do not fully collect on it. The gap between those two scenarios is not a matter of incremental operational execution. It is a binary question about whether the technology works, and no one, including Tesla's own engineers, knows the answer to that question with certainty today. Here is what Tesla actually is, stripped of the hype in both directions. It is the most successful automotive startup in a century. It forced an entire global industry to accelerate its electric vehicle transition by a decade. It built a charging network that became the de facto standard in North America. It created a software-defined vehicle architecture that established the template every serious competitor is now trying to replicate. Those are real, permanent achievements that no market correction can erase. It is also a company whose stock price, for most of its history, has implied a future that requires everything to go right. And in a business as complex and capital-intensive as building, selling, and servicing vehicles at global scale, while simultaneously developing autonomous driving technology that nobody has cracked, while navigating regulatory environments across dozens of countries, while managing a CEO whose attention is distributed across multiple major enterprises, everything going right is an optimistic assumption. The people who made money on Tesla were the ones who bought the dream early, held through the volatility, and were honest with themselves about which part of the story they were betting on. The people who lost money on Tesla were often the ones who bought the dream late, at prices that required the most optimistic version of the future to be true on the shortest possible timeline. It is worth it for investors who understand exactly what they are buying, who have a long enough time horizon to absorb the volatility, and who are comfortable with the binary nature of the autonomy bet. It is not worth it for investors who look at the stock price and assume the hard part is already done. The Gigafactory is real. The Supercharger network is real. The cars are real, and they are genuinely excellent. What is not yet real, and what the valuation most depends on, is the software that was supposed to drive itself. That is the economics of Tesla. The car is the product you can touch. The future is the product you are paying for. And the distance between those two things is where fortunes will be made and lost in the decade ahead.